Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I am your host, Dr. Daniel Crosby, and I am joined today by return guest, Clare Flynn Levy, CEO and founder of Essentia Analytics, a leading provider of analytics services to professional investors and allocators of capital. She's a former hedge fund manager, here today to talk about some really seminal, groundbreaking research that Essentia has recently published. Welcome.
Thank you. It's great to be back.
You were one of my early, I should have, a better podcast host would have looked and seen exactly when you joined me, but you were one of my earliest guests. So very, very, very glad to have you back.
Well, and a better guest would have checked also to see when was that, because what were we doing then? But I think we'll find I was doing the same thing that I'm doing now.
The same thing. Like you've been at this for a minute. And, you know, one thing that I love about you, behavioral finance is almost exclusively applied to client service stuff. You know, whether it's helping clients articulate goals, helping them understand their risk tolerance, keeping them in their seat in a choppy market. And look, I do a ton of that. It's super important. But there's this whole other world that I feel like we just haven't caught up to. There's certain people, you, Tom Howard, some of our friends at Taves, like that really see the importance of behavioral finance in the asset management side of the house. And I don't know, that's a soapbox of mine. I mean, it's why I wrote The Behavioral Investor, because I think it's at least as applicable to the selection of securities as it is to the servicing of clients. So it's awesome to have you and your perspective on here. I'm going to tease the study because it's really cool. Like it's really very cool. Your folks reached out to me. I probably get five or six press releases a day. They're almost always terrible. But when I saw yours come through, I was like, oh, this is a legitimate discovery. So I'm excited to talk about that. But before we get to it, for people who haven't been with us for all 300 episodes, tell us a bit about who you are and what you do at Essentia and what Essentia is all about.
Sure. Well, as you mentioned, I was once upon a time a fund manager for myself. I first was a long-only equity manager and a tech specialist at that. And then I was a long-short tech manager and therefore a practitioner, you know, in this space. And I'm by nature somebody who I would characterize myself as a continuous improver. And I think constantly about like, what am I doing that's working? What am I doing that's not working? How do I get a better return on my energy expended? And, you know, how do I tweak what I'm doing to make things better? And that's just sort of how I think about things. And so as a fund manager, you know, I was picking tech stocks during a tech boom and making lots of performance, winning all the awards, getting all the kudos, and not asking myself a ton of questions about how much of this is really down to me. You know, I was like, everyone around me seems pretty happy about this, so I'm going to go with it.
That's right. Yeah, this feels right.
But then, you know, when the bubble burst, here I was trying to figure out, okay, fine, what I was doing before is no longer working. What should I do differently to get a better result? And the reality is that I didn't have any useful data to go on, or at least I had the raw material, but it didn't have actual data insights to say, okay, when you do this, it makes things worse. When you do this, it makes things better. And that was all I really wanted to know, you know? So it was a bit like an athlete who wanted sports analytics, you know? That concept certainly, you know, found its home originally with Moneyball and has taken off over quite a long period of time. You know, it takes the world a long time to accept these things, you know, really embrace an evidence-based approach. But at the end of the day, in sports, it has very heartily been embraced. And in asset management, it just didn't exist. all we had was performance numbers. And you could look at your performance and say, all right, well, I performed well, I guess I'm great. I performed badly, I guess I suck. That's not actually the case, probably in either one of those, because it's a performance is just such a noisy number. So I set out to come at it from the other direction and go back to take the step all the way back and say, what is the job of a professional investor? It's to make decisions. Okay, so what kinds of decisions do they make? Not all decisions are created equal. So what are the various types of decisions that a fund manager makes? And it's a bit like, taking the sports analogy forward. If you think about it in tennis terms, you've got your serves, you've got your forehands, you've got your backhands. Like there's certain types of decisions, picking decisions, entry timing decisions, sizing decisions. You do them over and over. Sometimes they're, more impactful than others. But even if you're a low turnover manager, there's always a picking decision, an entry timing decision, a sizing decision, and so on. So you automatically, for every position, have at least 5 data points, as opposed to, multiply that by however many positions are in your portfolio, and then multiply that by every single day, that transpires. Now you have a much bigger data set to work with than you have if you're looking at 12 months of one performance figure. Did she outperform or did she not? So I thought there's got to be much more signal in that than there is in performance attribution. And, long story short, it's, 10 years later, we built a software platform that takes daily holdings data and does a ton of different analyses on that to help a fund manager understand what is it that I'm doing that's helping, and where am I showing skill? Where am I actually demonstrating that I'm a good decision maker? And I'll use that in my marketing, by the way. Need to be able to differentiate. And this is real, legitimate evidence of skill. And, I might not want to brag about all the things that I do that are detracting from the portfolio, but I should probably know about them myself. And I should probably try and do something about that, in the same way that an athlete will try and shave little decimal points off of times. You can make very small changes to your process and get little basis point, incremental improvements that add up to huge amounts. So it's something we built a business around, and over that 10 years, develop a methodology that is, what's being applied in that research you mentioned.
Yeah, we're gonna talk about the methodology in just a moment. It reminds me of the part in Moneyball where the old school scouts are sitting around the table and they're evaluating the talent, and they're like, well, this guy, this guy's wife is ugly, or like this guy has a weak jaw or something.
Yeah.
It feels like asset management is not too many years removed from that sort of low level voodoo thinking.
No.
There just hasn't been a whole lot of behavioral rigor or discipline around things. And you all are trying to change that. So I want to talk a bit about the methodology here. One of the parts of your methodology is this behavioral alpha benchmarking method that looks at least 7 data points. That's what I could find on the website. So it was stock picking, sizing, entry timing, scaling in, adjusting size, scaling out, and exit timing.
Yeah.
Let's take picking a stock as an example. How do you score decision-making skill there? Because, the tricky thing, it's like if I buy, ABC stock today, it's like, is that a success or a failure? Well, like along what timeline and sort of relative to what? So how do you take those 7 data points and score them?
Well, picking is actually probably the easiest, the least complicated one. So each type of decision that we're analyzing has its own sort of methodology that we use. But at the end of the day, what we're asking is, did this person's decision add value versus what would have been achieved by luck?
Yeah.
In the end, that's skill. And so with picking, actually, all we're doing is saying, let's compare. So first of all, we take all the holdings data from going back as far as you've got, and we construct from that what we call investment episodes. So an episode is like zero to zero life of a position in a portfolio, like in game tape, basically. And then we decompose the episode into the 7 different types of decision. So with picking, what we're doing is saying, all right, let's compare what would the P&L have been from buying 1 share of that stock on the day that you actually entered and exit it on the day that you actually exit it, but only 1 share. So we're getting rid of the sizing question with what if you bought 1 share of the index? And it needs to be that the index is relevant, right? So in the institutional space where I've lived most of my life, the indices that are being used are very, they're factor adjusted. So a value funds compared to a value index. You don't necessarily get that in the retail space or in the ETF space. And so that gets a little bit muddled. And as we, is that really good picking is that alpha picking or is that beta picking? If you're not being compared with the right index, it's not obvious. So we're getting ready to roll out the behavioral alpha benchmark for ETFs specifically. You heard it here first. But that's something we have to look at because you need it to be fair. And therefore, the benchmark becomes very relevant.
Yeah, it's always, do you ever pick a different benchmark for your purposes than the stated benchmark that the allocator is using? Because it seems sometimes I'll see people's benchmarks and I sort of roll my eyes.
Yeah.
Right.
I mean, it depends on who the client is at the time. So, we work with both managers and allocators. And the manager, often a manager will want to look at their portfolio versus an index that isn't the same index, the prospectus one. I mean, it depends on how what that index is, but they might ask us to load another index as an alternative, or maybe they have a special blended one that they want to use. We wouldn't include that in the behavioral alpha benchmark. That's it's got to be apples with apples type of thing. But when they want to look in the mirror at their own, go into great detail about what they're doing, what are their patterns, they might want to look at it versus that index, and they can. Likewise, for an allocator who maybe has hired a manager whose stated index is the S&P 500, but the allocator wants to look at it against something more specific, we can do that too. Yeah. But again, in the behavioral alpha benchmark, which is basically a ranking, it's like a database of funds that have been scored with a behavioral alpha score, measuring their decision-making skill. Those, for all of the funds, we use their stated benchmark just to keep it fair.
Yeah, this is the everything has to be explained to me in baseball terms. This is the baseball equivalent of wins against replacement, right? So you take like how many more games do you win with this shortstop versus the average shortstop at that position? It's kind of a similar vibe. So I like that. It's a very intuitive, very powerful stat. So Claire, one of the tricky things about investing in behavioral investing is that you can get a good result for a bad reason and vice versa. I think your tech stock picking days are a great example. Yeah. You probably had a lot of good results for some, probably some pretty mediocre decisions in some cases. How does Essentia think about this construct and try and account for it?
I mean, it all comes down to how many data points you have to work with. So, this is why past performance is not predictive of future performance, because you're looking at 12 data points in a year. And there's a lot of noise when you have so few data points to work with. But when you're looking at not a measure of outcome, but like the measure of what the investor's actually doing, the decisions that are being made, you, as we said before, have a lot more data points to work with. But you're also not just looking at one aspect of it. And that actually conveniently goes back to your baseball analogy. When we're looking at a manager's decisions, at what we call their hit rate, which is like their batting average. But this is not the batting average of, what percentage of the stocks you owned went up. That's sort of what people think of when they think of batting average. And they're like, I have a batting average of 80%. No, you do not. Like, that's not a real number of a batting average for a professional fund manager. even if you were looking at it at the episode level, you're talking like 60 would be huge. But when you're looking at the decision level, 50 is good. Most people make fewer profitable, like better than chance decisions than worse than chance decisions, actually, when we look at all the different types of decision. But they do tend to get more stock-picking decisions right than wrong. And that's one of the most important pieces of that puzzle. And moreover, the good fund managers, they don't just have a hit rate that's over 50, which is ideally what you want. They have a payoff that's over 100%. So payoff, it's sort of like a slugging statistic, but yeah, but actually payoff can it has a downside that slugging doesn't have. So it's looking at the average relative P&L on your good decisions divided by the average relative P&L on your bad decisions, and saying like, okay, you could get it wrong more than 50% of the time, as long as when you're right, you're very, very right, and when you're wrong, you're just a little bit wrong. Likewise, you could have a high batting average, but you have some real whoppers in there, and they just kill your performance, and that happens to people all the time. So that's a skill that really separates the wheat from the chaff in fund management world. And it's a combination of those two things that results in the behavioral alpha score. And that's why because you have so many data points and you're looking at like, does this guy get it right more often than wrong? And when he's right, does he more right than he's wrong when he's wrong? If the answer to these things is yes, that's a skilled investor.
It's wild to think that 50% is sort of a great. I think so few people understand that 50% is good, and I'm going to forget who to attribute this to. But yesterday I read someone wrote on Twitter like, look, if I'm being offered a deal, which you are in markets every day, like my base case should be it's a bad deal, right? Like I have to prove to myself why it's not a bad deal. Because my base case should be like, yeah, I shouldn't do this, right? It's wild out there. So I'm going to avoid a conversation around on base plus slugging and get into instead the study itself. So this was a really fascinating study, and this is kind of the meat of our conversation here. I want you to spend just a minute with it. You just gave a version of this disclaimer that the sort of a famous disclaimer, past returns are not indicative of future performance. See it on every piece of content ever developed. But your research has found that decision-making hygiene is 1.5x more predictive of beating a benchmark in the subsequent year. Did I get that right?
Yeah, you're right.
Yeah. Can you break down the study for us a little bit and what you found?
Sure. And from day one, the logical underpinning of this entire exercise has been, if your job is to make decisions and you have a reliable measure of decision-making skill, then, and that measure of decision-making skill is about P&L ultimately, but at the decision level, not at the overall portfolio level, it should add up to outperformance, just because mathematically it should. But people want to see the proof of that. And it's been a long road to prove it. But the first thing we did was develop the behavioral alpha score. And that was really just about boiling up all the different analytics that we do into one sort of apples with apples comparison. And then the next step was to look at, is it persistent, the behavioral alpha score? So does somebody who has a score over 50, so just to take a step back, the behavioral alpha score is looking at all of those 7 types of decisions made over the last 3 years. So that's the sort of timeline that we're looking at. If we look at the hit rate and the payoff on all of those types of decisions and boil it together, we come up with the score. And a score of 50 is what would be achieved by chance. Mm-hmm. So a score over 50 means you're adding value through your decision making. Score under 50 means that you're not. So the first question was, does somebody who has a score over 50 have a higher, does that persist? Is it a one-off thing, just like performance is sometimes, you have a good performance one year, the next year it's bad. Is this that volatile of a proposition? And the answer was, no, it's not. It is persistent. It persists for 3 years before it runs out of predictive power. So basically just saying somebody who's had a score over 50 is more likely to stay over 50 over the next 3 years than somebody who doesn't have that. But that's still not answering the question about performance.
Let me stop you for a second. What's the cliff at year 3? What accounts for that?
Now we don't know. I mean, it's just the statistical significance of it goes away. But you can speculate, life changes, things change. People's decision-making process can be affected by a lot of different things. And, you get thrown out of a routine, or you change firm, or the new boss says you have to do something differently, or you can get a different system, like who knows? Yeah. But you also could say, well, what about all the people who are trying to get better? Shouldn't their score change if they're getting better, if their efforts are not wasted? So there's that too. And we do have, we have a data set of people who are trying to get better generally. So it's a little bit unclear from that perspective. But it was at least saying, okay, this isn't a sort of flash in the pan measure. But then, what people really want to know is, does this predict performance? And it's like, well, logically, it should, because somebody who has made good decisions over the last 3 years, and the good decisions being decisions that, produce profit more often than chance, you would think would do the same in the going forward, especially because we just said it was persistent, and that should result in outperformance. But you don't know until you run the study. So the study included 123 long-only portfolios. It spanned 10 years, so 2014 to present. So in terms of a data set, it was like 532 investor years worth of decisions. And then we analyzed each of those 7 types of decision and used the behavioral alpha methodology to boil it all up into a score, and then looked at the predictive power of that score versus the performance turned in by those managers. And the answer was, a manager who has a behavioral alpha score over 50 is 1.5 times more likely to outperform their benchmark in the next year than a manager with a score under 50, which is basically what you said. And it's like, okay, that tracks. So, we're not saying a manager with a score over 50 is definitely going to outperform. What we're saying is, if you compare 2 managers and one has a score over 50 and one has a score under 50, the one with the score over 50 is more likely to outperform.
Yeah, when, it's sometimes we as a species shoot for more certainty than is available in the real world. But, I think the essence of being a great investor, a behavioral investor, is just tilting probability in your favor. Mm-hmm. So that's what you're doing here, right? I mean, you're not saying, look, this is not a slam dunk, but we can tilt probability in our favor, and all else equal, people who have a recent history of making good decisions should be more likely to outperform in the future. And there it is. There it is in the data.
Exactly. And if you're a fund selector or a fund buyer, you should be paying attention to this, because you're choosing between managers and you're often just looking at performance data and narrative, and bias around, like, this guy looks the part, he tells a good story. I love that stock idea he has. It's very, very hard to stay objective and say, well, but what evidence do I have that this person is actually doing what he says he does and is actually good at making decisions? And so you should want quantitative evidence of that if you can get it. And what this is doing is giving you that.
Will there be a time when we go to Morningstar or Yahoo Finance and look up an ETF we're thinking of investing in, and we're able to get an X-ray of the fund manager's behavioral alpha score? I mean, is that on the horizon?
It is on the horizon.
That is really neat.
On the horizon. Yeah. There is today already, if you go to behavioral-alpha.com you can sign up for free and access the tool that we've built that shows you all the different portfolios as dots on a scatter plot, and it shows you all of their scores and enables you to drill down. You don't necessarily know who all of them are, because in order to get portfolio managers to participate, they have to feel safe. And so we take all the data security and the permissioning very seriously. So they have the ability to determine whether you can see them, whether everybody can see them, whether only certain people can see them. But you can still see all the different, it's fascinating looking through the breakdown of different manager skills. And you can sort by peer group and look at, value managers versus growth versus emerging markets. And yeah, it's super interesting, but that's its own standalone tool. And I very much look forward to seeing these stats appearing in other people's tools, because I think they're just so powerful. And it's a testament to what can be done when you have far more granular data.
Were the participants in the study Essentia clients over that 10 years or no? Like, were they privy to their behavioral alpha scores over that time, or was that?
No, mostly it's their historical data set. So long before they met us. Okay.
Yeah, because, my next thought is, could greater awareness using tools like this lead to greater persistence? Does a fund manager become aware of her style drift or whatever, her behavioral style drift, as it were?
Yeah, you would love to think that they would. Like this idea of looking in the mirror before you leave the house, it's like a good call. You should just have a look. You could stop some stupid mistakes from happening. And the same goes with data. It's like if it's not a lot of work for you to do because somebody else is doing it for you, and they're just sitting down with you and telling you, look, here's what the data's saying, not judging you. I'm just giving you facts, and let's talk about it. And if you want help putting this into some practice and changing your process, we can help you with that. But for some people, it's just about, I'm getting questions from all the investment consultants about my decision-making and about behavioral analytics, and I don't really know the answer. And it's like, all right, we can help you with that.
So one of the, my last sort of formal question before I have you point us to this interesting research, because I had a good time reading. There were kind of 2 or 3 different write-ups of it that I enjoyed reading. It's really hard to get people to focus on process and not outcomes, right? I envision a day. Basically your scoring process, right? And I envision a day where someone goes to whatever the favorite data site is, and they see your behavioral alpha score there, and it's a 43, and yet the fund has ripped, for the last 3 years, because that'll happen sometimes.
Yeah.
What is Essentia doing to try and get people to focus on process and not outcomes, and how do we tell that story in a compelling way?
This is where there's a lot of lip service that's paid to focusing on process and not outcome. But the reality of it is that it is burdensome to do. It's much easier to focus on the outcome, and even easier yet to just look at stars or circles or hearts or the number of some visual thing, because your brain just wants to find a pattern. And I literally found myself doing this. I had to allocate some money in my kid's 529 account. And I went on Morningstar and I started looking at the funds that were available through this provider that we're using. And the names of them had nothing to do with the strategy. So it was all a bit sort of cryptic. And I really found myself just looking like, how many stars, what color metal, what am I doing? That's ridiculous. It bears so much deeper understanding than that. But the brain wants to just make a quick decision. So what we've done with this behavioral alpha score is turn it into a dot. It's a number. Like, you can do that. Make it into that what people want to eat, even though it's a vitamin. Even if it's super healthy. And that gets the manager to put the data in the first place and start even looking at that one number. And from there, it's very easy to go deeper and to help them identify very clear points in their process where they just need a little reminder, or it's something they haven't been aware of, or they haven't been looking at and can't necessarily spot when they're in the middle of doing it. Yeah. So we had this whole concept of nudges, which are not nudges in the academic sense of quietly herding a population in a certain direction. This is like, hey, you get an email and it says, our analysis, you'll recall, said that when you have a position that's been losing for 7 months, you should take another look at it, click here. And by taking another look at it and click here, you then get served up a set of questions that you said you wanted to be asked the next time you were in that situation that would help you like re-underwrite the holding or decide to sell it, but make a deliberate system to brain decision when you would otherwise be making a passive, biased, holding on to losers for too long decision. And by doing that, it's like you're not asking the manager to remember anything. You're just using technology to put it in front of their face in the moment when they need it. And then you're asking them to click on a thing and ask themselves some questions. And some people still will not do that, but a lot of people will.
I'm very much with you. This is one of there's certain just sort of trite little tropes in business life, right? Like hire for culture, train for skill. Like, well, that doesn't happen. We still hire the person with the more experience than less. And, I think about process over outcomes. But what I love about this research is that you linked process and outcomes, right? I mean, it's like these are not separate distinctions. The one is very germane to the other. If people want to read about this, they're going to have as much fun as I did reading about this. Where can they find this? Where can they learn more about this study and then more about you and your work?
Yeah, we have loads of research on our website. It's Essentia, which is like essential without the L, -analytics.com. And if you look in the news and resources section, you'll find white papers and blog posts and all sorts of things. There is a whole sort of mini site dedicated to the behavioral alpha benchmark. And as I say, if you go to behavioral-alpha.com, you can sign up for the app and have a little play with it. But there's more research coming. The full paper of the piece of research you and I have been talking about is just being finished off right now. And I'm super excited about it. So watch this space.
Yeah, we'll look for that. Thank you for moving us out of the scouting room where we're talking about people's jaw lines and into analytically driven part of the investment world. You're doing great work and it's much appreciated.
Well, for those in the audience who are soccer fans, I recommend, I've just been reading a book called, I think it's called Earned Goals, but it's basically about sports analytics in soccer and very much about the resistance that the establishment can put up. Yeah. But somehow in the end, the statistics will, reveal the truth.
That's right. It's what you're up to. And it's fascinating work. So Claire, thank you for being here.
Thank you.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.